Hi everyone, welcome back to Corporate Decoder. Today we're diving into Artisan Partners Asset Management's latest quarterly report. It's like peeking behind the curtain of a company that manages billions. Will we find a magic show or just some tired financial tricks? Let's find out. This report's story is about how a fund that did so well for so long is navigating changing markets, all while dealing with a complex financial structure. Before we get started, if you enjoy decoding corporate jargon into simple English, be sure to subscribe. We have a Discord community too for more in-depth discussions. Link in the description below. First, let's look at the balance sheet. It's like a financial snapshot. As of March 31, 2025, Artisan had about $214 million in cash and cash equivalents. That's a healthy amount of readily available money, a bit more than the roughly $201 million they had at the end of last year. Their accounts receivable, basically money owed to them for their services, jumped to around $149 million. This is quite an increase from the $11-19 million at the end of the previous year. This means they are doing better at bringing in revenue. They also had roughly 199 million borrowings. This figure is pretty consistent with the last period, showing they are managing their debt. Now let's move on to the income statement. This shows how profitable they are. Looking at the 3 months ending March 31, 2025, management fees were roughly $277 million, which is good. This is up from around $264 million in the same period last year, showing their growing revenue. Interestingly, performance fees, which are extra fees they get for doing exceptionally well, were basically zero this year compared to last year when they made a little bit of money. Their total operating expenses were about $197 million, up from around $187 million. Most of this expense came from employee compensation and benefits. They had non-operating income of about $10.8 million, boosted by gains from their investments, but that's less than what they had last year. Ultimately, their net income, the profit that goes to the company, was about $61 million compared to roughly $60 million last year. So overall, they are doing well. This translates to about 0.8182 earnings per share, which is a slight dip from the $0.84 per share they reported the previous year. The report also tells us that there were roughly 70 million shares of Class A common stock outstanding. Next, let's look at the cash flow statement. This is where we see the actual cash coming in and out of the business. Cash flow from operations was really good, nearly $158 million. This is strong, showing that they are making money from their core business. However, they used about $38 million for investing activities and nearly $92 million in financing activities, which includes dividends to shareholders and partnership distributions. Ending cash and cash equivalents was about $259 million. This is good. The strong cash number helps them stay stable. Moving on, the report describes how they value their assets. They use different levels depending on how easy it is to find a price. Level 1 is the easiest, using prices from active markets, while level 3 involves their own assumptions. A lot of their assets are valued using level 1, which are easily verifiable. They have some long-term debt, mostly in the form of senior notes. The interest rates are fixed, and they are paying them off according to schedule. Looking at where their revenue comes from, most is from management fees, which is normal for this kind of business. They don't seem to be heavily reliant on performance fees, which can be unpredictable. The report also mentions some recent accounting pronouncements. These are new rules from the accounting standard setters. The company says they are staying on top of things and are implementing the changes. The non-controlling interests refer to the portion of a company that isn't owned by the main shareholders. This is specific to their structure and reflects their partnership setup. Finally, let's talk about the tax receivable agreements, or TRs. This is a bit complex, but it's basically an agreement to share tax savings with some previous owners of the company. As of March, they owed roughly $342 million under these agreements. What about risks? A major one could be losing key investment professionals. If their star managers leave, it could hurt their performance and their ability to manage money. They also acknowledge that poor investment performance could lead to clients pulling out their money, which would directly hit their revenue. Now, my take on all of this is that Artisan Partners is a pretty solid company. They are able to increase their revenue and their cash position. A lot of the revenue comes from long-term funds. They are still dependent on economic markets, and some performance fees were down. If the stock market has a prolonged negative effect for multiple quarters, it will affect the company All in all, Artisan Partners seems like a company with a solid foundation, but like any investment firm, it faces market-driven risks. Alright, that's our breakdown of Artisan Partners' latest filing. Now, what do you think? Did you learn anything? If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, and I'll see you next time.